Welcome back. Time now for Mike Philbrick's Top Picks. Top pick number one on this day is in the realm of cryptocurrency. It's a Bitcoin ETF, specifically the 3IQ Bitcoin ETF, ticker symbol BTCQ on the TSX.
Call me crazy. When I was on in January, someone did ask about the digital currency space, and I did say, make sure you're rebalancing. The asset class is extremely volatile, but in that volatility, it's also had some pretty significant returns, and we had recommended or talked about it on the show several times over the previous few years prior to the last huge run. And I said, well, you want to make sure you're rebalancing this crazy animal, right? So when it goes up by 300% and you have, a 5% exposure, and that's 15%. You should be trimming that.
Right.
And if you trim that, then mindlessly in January, you would have said, oh, well, my 5% is now 2.5%, and I will top that up. And it's had pretty robust growth, lots of fund flows, and we've had the announcement of BlackRock starting to get involved in launching a legitimate ETF for Bitcoin in the United States. That is massively bullish for the entire ecosystem. In Canada, we've had the opportunity to be involved. 3IQ was the progenitor of these types of products, getting them listed, getting them available in a very safe way for investors in Canada to actually have a holding here. So I would recommend revisiting this. They have an Ethereum one as well. They have a neat twist on the Ethereum one where they're doing some yield farming, which is creating a little bit more yield in the portfolio. So I think digital assets deserves a look here. Again, it's a highly speculative asset. I will stress that. Small position, make sure you're rebalancing it. The rebalancing will offer tremendous tailwind, and have a look.
You used the word safe a couple of times. I assume you think this is safer than buying raw Bitcoin and sticking it in a cold wallet and so on.
Well, yeah, because you've got this, how many times have we heard about people searching junkyards and for their lost, so there is the saying that not your keys, not your coin. At the same time, one has to balance the behavioral rigor required to manage an asset that is a tangible asset. So I think, maybe as a start, put it in the portfolio. It's an easy, accessible way. The MER is pretty low. You don't have to worry about it. And you can even rebalance it in your portfolio. Right? What are the chances you're going to toddle off to your key and do some rebalancing and send it to your TradFi guy? That's just not happening. So I think for most investors, this is a really great way and shows leadership in Canada.
Okay, here's another interesting one, the Global X MSCI Argentina ETF, ticker symbol ARGT on the New York Stock Exchange ARCA exchange.
Hey, Paul, what's the best performing single country ETF this year?
Are you going to tell me it's Argentina?
Argentina. So, interestingly enough, I'm trying to draw people's attention to things that they may not be looking at. So what's happening? Well, there's a lot of inflation, but equities are a hedge to inflation, especially in Argentina. Further, you have the nearshoring and reshoring of production lines. Well, who's benefiting from that? A lot of Latin American countries. So Argentina at all-time new highs. Mexico also at all-time new highs, outperforming not only emerging markets, but developed markets. That's telling you something. Capital is going there. Pay attention. These are opportunities to diversify away from North America, giving yourself a different economic zone and different dynamics that are at play. So I think that, the Argentina, Mexico, Latin America, that is an area that not only has the opportunity to benefit from capital flows and reorganization of supply chains, but also their metals and minerals economies, their resource-oriented economies. They benefit from a weaker U.S. dollar. And nobody knows about them. No one's talking about them.
Isn't it true, though, in Argentina, there is a history of recurring fiscal and monetary crises?
Absolutely. 100% of the time. So, again, it's not something you're going to put your whole wealth in, but have a look.
Okay.
Have some strategies to allocate, to manage risk. But it's there and it's happening.
Okay. And here, perhaps in the same vein, India, the third largest economy in the world, the India Index ETF XID on the TSX.
Correct. Now, India surpassing China in the world's most populous country. Also, more Western rule than not, English speaking. So lots of good tailwinds there. And again, they're benefiting from this rebellion against China. So as the supply chains are getting restructured, you're already seeing companies like Apple take advantage of readjusting their supply chains to incorporate more India, less China. Very good growth coming out of China. It's significantly above, I think it's 5.9% GDP growth we're expecting in India versus what's in the U.S. This to me is, now it's runaways, it's done well, but I think it still deserves a look. It deserves, in your geographical portfolio that's non-Canada, non-U.S., these types of areas deserve a look.
Okay. Mike, thanks a lot for being here. We appreciate it.
First idea, Northrop Grumman.
That's right. So Northrop Grumman is one of 5 American prime defense contractors, the industry that Eisenhower famously nicknamed the military-industrial complex. It is an industry that we'd characterize as a moat oligopoly. It's really consolidated down from 100-plus suppliers at the end of the Cold War to just a handful now. And it's a moat oligopoly because there are barriers to entry, and they're rooted in the fact that Northrop and its peers have incumbency on these very, very long-running Defense Department contracts. And they also own the intellectual property and very sophisticated technology behind many of these products that keep Americans and their allies safe. The company operates in 4 different segments: space, aeronautics, mission systems, and defense systems. Very predictable, stable, consistent revenue that's rooted in the fact that 86% of their sales go to their primary customer, none other than Uncle Sam, that same customer underpinning substantially all of their $80 billion backlog. So these shares have stabilized over the last 6 months after pulling back about 23-24% from the peak last year. We think that pullback took place because the U.S. debt ceiling and potential government shutdown when concerns were front and center earlier this year. And then specific to the company, they're trying to grind through and earn through $1.2 billion cost overrun on the B-21 bomber contract, which was a fixed price contract, obviously very challenging inflationary times. Looking ahead, though, to fiscal 2024, one of the big catalysts that we see here is the likely award of the Next Generation Air Dominance contract, which is the successor of the F-22 fighter jets, which have been in service for 25 years.
Wow.
And it's,
F-22 has. That's amazing.
Yeah,
you think of it as
time.
being much newer. Yeah.
And that's likely going to be a $16 billion contract. We expect that Northrop is going to be involved and will get some part of that contract award. These shares have generated pretty good competitive returns of about 13% compounded over 3+ decades, which is competitive with the S&P. So we like it here and bought the pullback quite recently.
And Shopify, you think, has upside from here?
Yeah, this is a fairly new addition to our portfolio as well. Shopify, of course, Canadians know, it's the e-commerce enablement giant, earning revenue, recurring revenue through a subscription model, and then also ancillary merchant services like payments, working capital financing, and shipping. And we changed our tune on this fairly recently. Good work led by my colleague Ian Chong. The company made a strategic error and tried to get too deep into fulfillment and logistics, which was expensive and was costing them a lot in terms of lost profitability. But several newcomers to their C-suite and their boardroom, including the CFO who came last year, a former investment banker, have sharpened the company's focus both on profitability and growth. And just to illustrate how dramatic the pivot in the business model is, having divested the logistics business, consensus analysts forecasts have the company growing earnings 800% year over year, given the workforce reduction and shedding the costly fulfillment centers. So the stock's in a nice uptrend. It's still well off its high, and we think given the growth profile, valuation is sensible here.
And your final idea is Brookfield, which has been under something of a shadow, real estate concerns.
That's right. So Brookfield is obviously one of the world's foremost asset managers of private market assets, real estate being a big one, renewable energy, insurance, reinsurance, private equity, infrastructure, and the list goes on and on. Deep operating experience, boots on the ground in Canada, the United States, the UK, Australia, India, Brazil, just to name a few. They're owners and operators of these long-duration real assets and also third-party managers of outside capital. And the flows of money into private market assets are outstripping flows into traditional stocks and bonds. These markets are less efficient, and there are outsized return opportunities, especially for skilled investors and capital allocators like Brookfield. And so the company has been just hoovering up money and now manages over $800 billion. And the shares have generated a compound annual return of 15% over the last 25 years. And the math on that is if you'd invested $1, back in 1998, you'd have over $20 now. So great compounder, nice pullback, and we believe in the management team, the strategy, and the markets that they're getting after.
So you think Brookfield at this stage, somebody who passed up on Brookfield is going to be sorry down the road? Do you think?
Yeah, I mean, you buy dips in companies like this that are massive compounders, multi-decade proven compounders, and leaders in their industry. So that's exactly what we're doing here.
Brian, thank you very much indeed.
Pleasure. Great to be here, Andrew.
Let's get to those top picks. Starting off with Laurentian Bank. Potential takeover play here.
Right. So to be clear, this is really a short-term, event-driven pick. The cat's out of the bag. They're the ninth largest bank in Canada with 50 billion in assets. They announced they want to maximize shareholder value, which means they're for sale, and that doesn't happen very often in Canada. So it's a unique opportunity for competitors to increase their market share, especially in Quebec. And it should be very easy for any of the traditional banks to improve the return on equity by cutting costs and cutting overhead and lowering the funding costs. And we don't think the regulators would object in any event. We see sort of TD, Scotia, maybe CIBC and National. And Desjardins the likeliest suitors, but there's some outliers that might be interested, like Power Corp and Wealthsimple, as a name that came up when we were looking at the universe, and maybe even a U.S. bank. So the book value is $60 a share. It's trading at 43. Yes, it jumped up from the mid-30s, but we think realistic price, is closer to book, so in the $54 to $60 range.
54 to okay.
Yeah. So we see 25 to 40% upside from here. We're pretty confident there'll be a transaction. And in the meantime, you're earning 5.5% dividend, while you wait for the process to play out, basically.
That's interesting. And I wonder, will the government object on competition grounds? It doesn't seem to have a problem with fewer and fewer banks in this country.
Yeah, I mean, I don't think HSBC is a problem. The Royal Bank's buying them. Laurentian is the ninth player. I mean, I think the government prefers to see a smaller number of stronger banks than smaller, weaker players. I mean, Laurentian Bank is in decent shape, but it's very challenging out there for smaller banks to compete against, the 800-pound gorillas out there, and there's six of them, you could hardly blame Laurentian Bank for putting a for sale sign up, and shareholders hopefully will be rewarded from here. I don't think they're going to get a premium to book, but close to book, I think is a good return, risk return at this point.
It's interesting with HSBC, London-based HSBC. Back in 2012, the U.S. Department of Justice said it had become a preferred financial institution for the Mexican and Colombian drug cartels. So I wonder, is RBC having a good look around the books there? As
we know, a lot of the Canadian banks have gotten caught up in, in stuff like that, and
in the Caribbean, you mean?
Well, they used to have a big presence in the Caribbean, Canadian banks, right? All banks have, I guess, have been guilty of having the wrong type of clients.
Your next idea is Jameson Wellness. It's out of favor with investors right now.
Right. Well, they're Canada's #1 brand of vitamin and nutritional supplements with a 25% market share. And since they went public 6-7 years ago, they've increased their sales and profits every year through market share gains, growing their export sales and adding new products. And they just announced a U.S. acquisition, so we're going to see the growth actually accelerate with this U.S. acquisition. So they have a platform in the U.S., and also they've teamed up with one of China's biggest private equity companies to expand their distribution in China and really control their own direct distribution now. And so this stock used to be very expensive, and now it's never been cheaper, even though we think the growth prospects are better than ever. So, it's only trading at about 18 times earnings. It used to be close to 30 for many years. And if you look at the comparables, in the U.S., they're trading at much higher multiples than that. And recently, a company called Blackmores in Australia, which is about the same size as Jameson, but much less profitable, was just acquired by a Japanese pharmaceutical company for 23 times EBITDA, which would value Jameson at $60 a share, or double what it's trading at today. So this is a good, high margin, high quality, steady business, and it's just a great entry point to buy it at these levels.
Okay, and then finally, let's have a look at your last idea. You don't generally invest in energy stocks.
Right.
You see this more as an infrastructure play?
Well, we see it more as an environmental services company.
Oh, okay.
Yeah, the bulk of their business is processing wastewater for oil and gas companies, operating in industrial landfills, recycling metals. But they also have an infrastructure company, which is basically midstream processing and storage facilities and the pipelines, small network pipelines. The company generates very attractive EBITDA margins of 35 to 40%, very strong free cash flow, a great return on equity. They just bought their biggest competitor, Tervita. And the reason the stock has come down a lot is because the Competition Bureau has ruling that they have to divest of about 1/3 of the facilities that they're buying. And so the company's appealing that, and we think they have a good chance of winning. The shares traded only 5 times EBITDA and 9 times earnings, and the company's constantly buying back shares as we speak, and you're getting a 6% dividend yield as well. So we think the stock's going to be re-rated eventually as more of an environmental service company, an infrastructure company, as opposed to an oil services company, which usually get low multiples. So if we do a sum of the parts analysis, we see a stock that's theoretically worth about $12 a share.
Thank you very much indeed, Stephen.
You're very welcome. Thanks for having me.
First idea, ASML Holding, big producer of technology for making chips.
That's right. It's a semiconductor manufacturing equipment company, headquartered in the Netherlands, founded in 1984. They are in this cutting-edge technology. And again, going back to the whole technology space, it's important to look for names that are not overly expensive and not chase the frenzy around some particular names, and look for good valuation companies or reasonably valued companies. So ASML specializes in photolithography systems for integrated circuit production. So they supply the equipment to companies, almost all semiconductor companies, but more prominently Intel, Samsung, and Taiwan Semiconductor. So they are the company behind the scenes of all these semiconductor companies, including NVIDIA. And when you compare valuations to NVIDIA, we talked about NVIDIA being at 45 times price to sales. ASML's at 9.9 times price to sales. They are the dominant player in this space. They basically allow and power these companies like Intel and Taiwan Semi and Samsung to basically create smaller and smaller and more powerful, more potent chips along the way. When you look at the future, there's no doubt that artificial intelligence, 5G, cloud computing is the future. And ASML is the company behind the scenes to create the equipment, to create semiconductors, to advance these types of technologies. Asia is 90% of total revenue for ASML, so huge growth market. We continue to see strong revenue expansion, good earnings growth, and strong return on invested capital for ASML. Just last week, management reported earnings that surpassed analyst expectations, also boosted its full year forecast. It's only trading at 1.3 times estimated PEG, price earnings over growth, so not an expensive stock. So I like this name. I've highlighted these types of names before. I think this was a name that we picked as a topic also last show. Okay. It's here again.
Okay. Canadian Pacific would be among your favorite names in rails.
Yeah. So as I kind of mentioned earlier, I like to own names that are in a very few competitive, less competitors around them. So oligopoly type of names. So they are one of the leading players in the railroad industry, number 2, I think, right now in terms of market cap. They've got a very robust network connecting key markets right across North America, Canada, US, Mexico, with their acquisition of Kansas City Southern that allows them to even grow further. They've got about 20,000 miles of rail in operation. So really, they're getting their customer goods right across North America to all different ports and so forth. Management has been strong. They're highly committed to enhancing profitability. That's been very impressive over the years. So efficient management style, strategic investments, and steady margin improvement makes it a good name to hold within the Canadian space. With the economic recovery still coming and moving and ongoing, and the rising demand for freight transportation services, I think that CPKC is a good name to hold. For decades, it's been outperforming the TSX for decades. And it's a name that it's slow and steady and good part of the portfolio to own.
Okay. And then your final idea, Mercedes-Benz.
Yeah, so obviously Mercedes-Benz is a leading manufacturing of premium or luxury cars and vans. They command a strong global presence, strong global brand, rich history of innovation. Customer loyalty is strong. Most customers that own a Mercedes, their next car is a Mercedes. Forecasted 2023 calendar year revenue is 153 billion euros. Most of its sales coming from Europe, Asia as well, but that's a faster growing part. And of course, they're well positioned to capitalize on the improving growth and long-term growth of the Asian consumer, and of course, improving supply chains since COVID. They're also very committed to the battery electric vehicle space. In fact, Mercedes wants to get to a full electric lineup by the end of the decade. So by 2030, they want to be only electric. That's a 40% growth rate in that market for Mercedes. That could potentially challenge some of the incumbents like Tesla. And I think they can really put up a good fight against that. Another thing to consider with some of these luxury brands, whether it be Mercedes or LVMH, which we talked about and whatnot, these types of companies are better insulated from economic downturns because when you look at the spending patterns amongst affluent customers, they don't get affected by economic downturns or weakness. Their Mercedes and other companies like that have price inelasticity. They can move the price regardless, and the demand will still be there to a certain extent. And I also note that the growth rate of global population of high net worth individuals is growing by about 5% a year, which is faster than the growth rate for your mass market automaker. So that increases Mercedes' addressable market going forward. Just last week or this week, I think the management also raised its earnings guidance for the 2023 full year. The stock is trading at 5.7 times earnings. So not only is that cheap, but that's also a meaningful discount to historical averages.
Stan, thank you very much indeed.
Thank you. Good to see you, Andy.
Welcome back. Bruce Campbell of Stonecastle Investment Management has been on the show this hour. Now it's time for his top picks. So let's dive right in. First pick, Avanti Helium. This is interesting. The helium space in general is interesting right now, but why Avanti?
Yeah, it sure is. I mean, we've talked a lot about oil and gas in the segment, and what we're seeing is that with the helium sector, it's growing, continues to grow, and it's probably a little bit more stable than what you would expect from natural gas. What we like about Avanti in particular is that the management team comes from the oil and gas side of the business, and they've just step by step done everything they need to do, executed flawlessly. Takes a little bit longer sometimes than the market would like, but they continue to deliver. So what they do first, they found their properties, they drilled their properties, they got successful results from drilling, and then they've just recently announced as of yesterday that they have a facility in place, or they have a company that's going to do facilities for them to process the gas. The next thing that we're looking for is an offtake agreement, and they're talking about being in production in early 2024, where we'd expect probably next year them to have free cash flow somewhere in the neighborhood of probably around 25 million. That'll grow to 40 million the following year. And what that'll allow them to do next year when they start getting that cash flow is drilling more wells and then putting another facility in place. So that's where they could really ramp up. The stock's really kind of under the radar. Most people don't know about it, and they haven't seen the significant the significant steps that the management team has taken, and the one yesterday was gigantic because they have been able to do that, and it's no capital from their pocket that's being put out. And so you have another company that's going to do the processing for them, which allows them then to set up everything for an offtake agreement, which we would expect to see announced, probably sometime in the next few months as they lead towards that production starting later on this year.
Okay, your next pick, Rekor Systems. This is interesting because it's listed in the U.S., but you cover Canadian stocks. Why did you choose this name?
Well, we're just trying to keep you on your toes. It's one that we sort of discovered and we really liked it. And we do some U.S. stocks, and so this was one that we added to our portfolio. And the talk today, everyone's talking about AI, and this is a company that uses that AI to deliver results. And where they work is really for infrastructure. So think about a lot of roadways. There's cameras everywhere. Their technology gathers all that data and then provides it back to the different municipalities or law enforcement for them to use in a constructive way. And so a couple of examples that, I'll throw out for what they're doing is, if you have a traffic flow before, you used to have people sitting in the corners counting cars, or you had those like little rubber things that you would drive over to count cars. Well, now they have technology and cameras that can do all that. So it helps for a few different things. One is traffic patterns, but also routing traffic at certain busy times during the day. And then the other really interesting one that they just talked about in a news article that was on Fox Business was they actually had police make a drug bust down in the U.S. And what they saw was that this vehicle kept making the same pattern over and over and over again. And the AI picked up on this and it reported it to the police. And then the police happened to pull this person over for something else. And when they did, they said, oh, hey, we noticed from this AI that this person has the same traffic pattern. They were able to search the car and they found drugs and weapons and cash. And so that person was convicted. So it's a way to make things safer as well. It's really under the radar. Most people don't know about it. It does tend to be fairly volatile. So if you're looking for something that's going to be stable, that this certainly isn't the stock for you. But if you're looking for high growth, there's lots of opportunity in this one.
And your last one is another technology company. This is Copperleaf Technology. What's behind this pick?
Yeah, it's a little bit behind the scenes as well, not sort of the mainstream name. But if you think about large infrastructure and utilities, they have planning for multiple decades. So they'll plan for 40, 50 years on first off, like how they have to utilize those resources, how they build those resources, how they maintain those resources. And what Copperleaf's technology does is allow them to be able to put all those scenarios into their software, and it helps them to optimize those assets. It's a huge benefit for them because before this was, something that was done with spreadsheets or with kind of feeling and gut, and now you're moving into technology. The thing with that is that you're dealing with really large organizations, and so you have a super long selling cycle, one that quite often is difficult to get into. And so recently, Copperleaf has announced that they've partnered up, and one of the partners that they have is SAP, the big software manufacturer and services company. And so that's going to help them get in the doors of many of these large institutions, and it'll allow them to sell. The selling time does take a while, but now we're starting to see that ramp up from the partnership. So it's one that's under the radar. Most people don't know about. Most of the analysts that we've talked to really like the company, both from an execution standpoint and what the addressable market is and the opportunity that they see in the future for this. So it's one that we own in our growth funds.
Wonderful. Well, thank you so much. That, of course, is Bruce Campbell. He's portfolio manager and president of Stonecastle Investment Management. He's been with us this entire hour, taking your questions on Canadian stocks.